Donald Trump's trade war make America great again or tip the world into an all-out tariff war? This is Ticker Hotshots. Hello, I'm Ahron Young. Great to be with you. Coming up on the program today, Trump's trade war. It's what we are talking about, and there's been a big week in that too. Plus, earnings from some big companies, including Amazon and Ralph Lauren. Gold prices fall and the ASX rally hitting an all-time high once again. And to help break it all down, we're joined by Rodda from Capital.com. Great to see you as always.
Absolutely.
All right, let's get straight into it. And Donald Trump is igniting a global trade war, slapping major tariffs on China, Canada and Mexico, sending shockwaves through economies worldwide. He's given Mexico and Canada a 30-day reprieve, but what impact will this have on other parts of the world that rely on international exports? Australia, though not directly targeted, could face fallout in sectors like iron ore, beef and canola oil. And what happens to China usually eventually happens to Australia as well. Analysts warn a prolonged dispute could sink currencies and also disrupt global trade flows. Your thoughts on this?
It's hard to disagree with that premise. I mean, that's exactly what it's designed to do, really, which is to put pressure, economic pressure on places like China and obviously for, US President Donald Trump, places like Canada and Mexico for obviously slightly other reasons. But that's more or less how it would manifest in the global economy. That's what investors are worried about, that if we do see an all-out trade war and these kind of tit-for-tat measures, which actually have been fairly contained so far, and there's hope that maybe Trump's a little bit more considered this time in the way that he approaches tariffs, maybe slightly more tactful than in the first term, that we will see a much weaker global economy. Australia probably won't be exposed to tariffs. There's really no reason for Trump to impose tariffs directly on Australia. But like you said, we're exposed to China. And if China slows down, its economy is already quite weak, then we will see the ramifications of that.
Yeah. I mean, some are saying it's a bullying tactic to essentially threaten tariffs on a country that doesn't do what the Trump administration wants.
Yeah.
Yet it seems as if Donald Trump rolled over very quickly when it came to Canada and Mexico. They didn't have to do much to get out of the tariffs. Do you think Europe will be watching and China will be watching that, saying we just have to give him a little bit, give him a win to show face, and we don't have to worry about the tariffs?
Europe definitely, China to a lesser extent, just because they're an adversary and they also have to basically maintain prestige and they're a competitor and they can't really be seen to be giving up too much ground because, clearly they're looking for some level of supremacy as well. Arguably this is a battle of, one hegemon versus another, or at least a looming one. But Europe definitely, and, we've already seen more or less the Europeans talking about how, they'll come to the table when it comes to negotiations, showing, especially Macron, like a fairly strong posture that they'll stand up for their own interests. But at the end of the day, what we did see with the Mexico and Canada situation is that at least when it comes to allies, Trump is probably using this as a negotiating tactic rather than wanting to, seriously harm their economies. And it's effective. Everyone kind of knows the rules of the game now. So I think Europe will comply because, clearly you don't want to pick a fight that you're going to lose. So again, China's a slightly different situation because they're a strategic competitor. But definitely, it looks like it's a negotiating tactic. Markets quite like that. Europe will probably come to the table, even though there will probably be some small tariffs applied to parts of their economy.
You could say that the US consumer lifted China out of poverty, and so many workers were able to get into middle class, at least working class life, thanks to the US consumer. If we watch more tariffs being imposed on China, and they could get stronger than the 10% that we have seen, it will have an impact on both the workers in China because the demand will be lower, but also you would imagine on the US as well. This could reshape manufacturing around the world too, and that could really impact China.
Yeah, it could. And it's part of the reason why I think China has been so slow to try and stimulate its economy through the last 3 or 4 years because of this property crisis, is because it's got one eye on the future, more or less, that it's trying to restructure its economy to be much more self-reliant, decoupled from the United States, make sure that it has a strong and thriving consumer base. And it also moves up, say, the manufacturing chain into high-value products rather than basically widgets.
The Soviet Union tried a circular economy. How did that go?
Well, China hasn't gone the Soviet route. In fact, as you said, it basically got itself out of poverty by using its huge, supply of cheap labour in order to basically export very, very cheap stuff to the rest of the world, which had its own impacts for 20 years in terms of deflation, overcapacity and all these sorts of things. But it was a symbiotic relationship between the US and China. Both more or less for 20 years benefited from it, with the exception of obviously a large swathe of US workers who lost their jobs and their livelihoods, and their standard of living stagnated for 20 years. But going back to the point, this whole drive from the Trump administration on China is tied into reshaping the US economy and bringing manufacturing back on shore. Scott Bessent, the new Treasury Secretary, has spoken about it. It's probably, in my opinion, slightly too crude because there's certainly things that probably won't come back. You're not going to see the Rust Belt re-emerge as a steel-making powerhouse. But when it comes to tech and these other high-value industries, chip making and all that kind of stuff, that's the stuff that the US could probably do and compete with China. And that's about that kind of long game, is to decouple from China and bring back a lot of those manufacturing jobs to the United States.
Well, investors are on edge as US stock futures tick higher in anticipation of significant corporate earnings reports. This is a headline from Reuters here because it's ending the choppy trading. Amazon jobs report in focus as well. Key companies including Honeywell International, Ralph Lauren and Amazon set to release their earnings, which could signal a critical turning point for the markets. This is interesting, particularly Honeywell splitting itself into three. This is one of the big corporates in America making a really big change here. What have we seen from these big companies this week?
Well, mostly it's been focused on tech earnings, largely. There is an interesting dynamic at the moment where there's more sort of M&A activity or kind of reverse, where you get these kind of splits going on, and that's sort of an indicator potentially of looser financial conditions in the United States as interest rates have come down and people are pretty confident about the future. Sentiment's really, really strong. But really the focus has been largely on tech earnings. Alphabet was a little bit disappointing. Amazon this morning delivered really strong results from the past quarter, mostly driven by strong US consumer activity through the holiday period, but they're a little bit sort of dour on the quarter ahead, or at least compared to market expectations. One thing, and we've spoken about it a week ago, was there's this ongoing concern in US stock markets about valuations, and in particular how richly valued some of these tech companies are, and concerns that maybe this huge amount of investment going into artificial intelligence won't see the return as before, or they're being a little bit slow to monetize it. That was the issue with Alphabet this week, and that's why the DeepSeek sell-off was so significant.
But it's not necessarily the issue with Amazon. Why is Amazon a bit worried about the next quarter?
Well, that's more of a consumer concern. There is the element too of monetizing AI technology, because their artificial intelligence investments going to AWS, which is supposed to be their major growth driver going forward.
It also powers their distribution centers, we're always told.
Yeah, I mean, that's what AI is ultimately. It's a efficiency tool. You cut out workers, you cut out all these sort of
planners.
All that kind of stuff, yeah. So it's an efficiency dividend. Amazon's mostly a consumer story. There was a little bit more concern that maybe the consumers will sort of pull back a little bit on their spending going forward after what's been 2 years of really robust consumer spending, despite higher interest rates and some other headwinds. So that was that kind of story there. But I mean, it has to be said objectively, they're still really strong results, still strong performing companies. The investors are just setting really high bars for these companies to meet.
That's not necessarily a bad thing. Investors have been taking for quite the ride over the past 5 years. If you think about all of that money shoved into tech and the valuations, as you say, going quite high, caution isn't a bad thing because it can prevent a bubble.
Yeah, exactly. And it's sort of when you see sort of the last bear in the market turn bullish that you normally go, oh, this is a little bit scary, because in principle, all the good news is probably priced in, all the buyers are in the market at that point in time. So, this is the argument partially that, we still, despite high valuations and two really phenomenal years for Wall Street, that maybe we can see a third, is that yes, investors are fairly confident, but we're not seeing those signs of euphoria just yet, where silly things are starting to happen in the crypto space, definitely, but in terms of equity markets, it's not at that kind of outrageous dot-com bubble levels just yet.
You see, Donald Trump isn't just the president of the United States. There are many signs that he's also the president of the New York Stock Exchange, as in he watches it so closely. And some say that 2% drop we saw on Monday because of the trade tariffs that he'd announced on Canada and Mexico were the reasons why he pulled back so quickly as well. Very closely, and surely there is a massive impact on investors knowing that there's a Trump in the White House.
Yeah, without a doubt. And there's this argument that effectively, there might be some sort of self-limiting element to Trump's actions because of any kind of stock market sell-off, which can be a little bit of a self-perpetuating cycle in many respects. Markets move less on the anticipation that if they do drop, Trump will basically back off and be able to, sort of steady the ship a little.
So investors control decisions at the White House in the end.
Well, it's kind of reflexive, I guess. guess you could say. It cuts both ways, but certainly markets have an impact without a doubt. I mean, you know, we laugh at on the desk at work. We laugh about it all the time. Sometimes we play the clip of when Trump, you know, threw a press conference just to celebrate the Dow hitting 30,000 and called it a very sacred number. It's really, really funny. But he certainly looks at the markets. He certainly uses a stock
You
market.
investors have a laugh in your little office, don't you?
We do. Yeah,
real gas.
Yeah, we totally do. Just up in our ivory tower. It's wonderful. But, you know, again, investors are of the belief that any stock market drawdown will be something that limits Trump's most harsh impulses. And again, it's a reason for confidence, even if it might be misplaced.
Gold prices have taken a step back as US Treasury yields have strengthened ahead of crucial jobs data. Investors are closely monitoring the economic indicators, which could signal shifts in market dynamics. Gold is usually seen as a really safe place. Don't need safety at the moment?
No, we need safety. Investors, or some investors, seem to need safety. There's a few things that gold can be, and sometimes it's just one of those narrative things. People like to kind of ascribe a story to gold if it's just going up for some reason. That's true for all financial markets, but gold seems to be quite good at that. The big development this week was actually some softer than expected US data. That put the US dollar on the back foot slightly, and also yields have come off quite significantly. Gold doesn't yield anything, and it's also priced in US dollars, so when they drop, it tends to boost gold a little bit. But I think underlying all of the strength in gold over the last 12 months is anticipation of the Trump administration to some extent, but also years and years of policy in the United States of a little bit more American first, which, you know, the Democrats were sort of dragged towards because of the impact and influence of the Trump administration the first time around. And then also what I would describe, and most people would describe, is pretty significant fiscal profligacy from Trump to Biden, and then probably Trump again, where we're seeing these huge run-ups in US government debt. The reason why that's important is that there's a little bit of a crisis of confidence in governments around the world to be able to maintain public debt levels. And then the other side of that too is that with the US and China trade war, there is a lot, and other geopolitical risk, I should say as well, major central banks, especially in China, are accumulating a lot of gold with their US dollar reserves instead of buying US treasuries, which they have in the past, mostly because they don't want to be exposed as much to the United States and US sanctions, but also they don't want to subsidize lower interest rates in the United States. So gold continues to climb higher, and it's really hard to see at the moment gold pulling back because all of those factors are really pointing to a more positive gold price and look unlikely to reverse in the short term.
You spoke about something I'd like to touch on, which is government debt around the world, right? We're sitting here in Victoria, in Australia, one of the most indebted governments in the world now, and the Australian government not doing too well either. Is this becoming a threat? Post-COVID, a lot of governments ended up with a lot of debt, hasn't gotten any better during the crisis of the past couple of years of inflation and governments spending more trying to prop up their economies as well. Is this something that we should be worried about, or is everything okay?
It's hard to say. I mean, no one really knows the exact level of government debt, which is too much. Over the last month or so, we did see a little bit of a meltdown in UK bond markets and subsequently the currency as well, and equities, really on the basis that there were concerns that the run-up in debt that they were likely to see going forward was not going to sustain growth at the kind of levels to be able to continue to service that debt. I mean, most economists nowadays realize that, you know, at least when it comes to sovereign debt, which is different from the debt sustained by corporations or a state government, is, you know, more or less an accounting feature, and it means that, you know, you can continue to print currency as much as you need, constrained by inflation, as long as you continue to see the kind of growth levels to be able to, again, service those debts at the interest rates that you're basically allocating that debt at.
But what happens if the agencies, the rating agencies...
The rating agencies don't really matter with those sorts of things. I mean, again, in principle, a government...
But in terms of servicing debt,
the market
can make it more expensive, right?
That probably used to be the case, and then you saw it particularly through the QE period in the 2010s, that a lot of the rating agencies realised that basically governments can't really default on their debt. There can be things that happen that obviously cause sort of levels of restraint, like currency crises or interest rates going up because the markets want higher compensation. But again, like a government like the United States can always just basically print more money and pay them back. The problem is that if you're running up these debt levels and the growth levels within the economy, and especially if it's being constrained by high inflation, aren't enough to be able to service that debt at the rates that the markets are willing to pay for it. So they'll, as a result, markets will lift rates to compensate for that risk and shortfall. So that's kind of where the problem comes in. That's where the UK potentially ran into a bit of an issue a month ago where the markets were like, oh, okay, will growth not be sustained at a level to be able to service this debt going forward. The United States doesn't have that problem. The Australian government doesn't really have that problem either. The problem is that you don't really know where that magical level is. So there can be a kind of tipping point that you get to where all of a sudden the markets are in a bit of a panic because of sovereign debt levels, and you really didn't see it coming.
But we're not there yet.
The Australian government's debt levels are really quite modest. 40 to 50% of GDP is nothing compared to the 110% of the United States, more in other European economies. So we're okay. We have other issues, productivity, all these other things where growth rates and living standards are slipping. That's the problem. Debt at the moment for us is not the biggest concern.
The Australian share market has seen a remarkable surge, with the ASX 200 rallying by 1.2%, marking its second biggest day close on record. Now, investors are celebrating this as well because it's seen as a boost reflecting growth and optimism in the economy, which is much needed. As we've been discussing, major stocks across various sectors contributed to the impressive rise as well. This is good to see, obviously, a reflection of perhaps some optimism. It's been a pretty dark period for investors over the past 12 months.
Yeah, well, it's really interesting because we've got the market continuing to grind higher. The ASX has underperformed the rest of the world. That's our issue with a lower composition of tech within the index.
Yeah.
But we're up by about 7 or 8% on a nominal basis last year, 12% if you include dividends. The interesting thing for the ASX 200 is, why the market continues to move higher despite pretty mediocre earnings growth and pretty mediocre economic conditions, both domestically, but in China as well, which is a very significant driver of obviously mining profits and mining valuations. So that's kind of the knock against the market right now, is that really the factors that are driving it higher are mostly global in nature and pertaining mostly to global financial conditions, which comes from the really strong sentiment that exists in the United States. Both because of the AI boom, but also strong profit growth there and the expectations of lower interest rates. So things are really good at the moment for Aussie investors. Anyone with a super balance would probably have seen a fairly strong return through the calendar year. If we continue on this kind of path, which most investors are sort of positioned for, the 24-25 financial year might be fairly solid. The bigger issue for investors now is whether you're buying these stocks at too expensive a price because they're not delivering profit growth.
Right.
Banks are a great example as well. CBA, basically an ex-growth company that is appreciated by 40% over the last year or so at a record high, but the domestic economy is slowing down. The only reprieve at the moment looks like a potential rate cut in a few weeks' time. So that's the kind of concern. Investors would be very happy with
Have the rate hikes been good for the bank's bottom line? Is that why?
No, not necessarily. So it's interesting. Rather than the level of interest rates and the cash rate for the banks, the more important dynamic to look at is probably the shape of the yield curve, which is effectively what is happening at the short end of yields or interest rates, so over the very, very months to a couple of years, all the way towards the back end, which is like 20, 30 years and all that kind of stuff. And why that's important is effectively what the banks do is that they take short-term liabilities, which are more or less funded at the short end of the yield curve, and then they lend them out at those higher rates, which are manifested at the longer end of the yield curve, which are driven more by market rates, and those are expectations around growth and inflation. So in times when that's sort of upwardly sloping, the banks do reasonably well because their margins are well supported, because again, they're making money off those longer term assets. But in the short term, if it's rather flat, and even if interest rates are kind of getting cut and that remains reasonably flat, their profits won't be great. What's happening now, though, is there's those expectations that short-term rates will come down. That'll be good for the bank's margins, at least for a little while, as well as credit growth. And that's why we're seeing some optimism coming through the banks. But again, we're not seeing a great deal of credit growth or a really strong growth in bank profit margins, bank profits over the last year or so. So that's really not the equation right now. But that's the dynamic you look for. A rate cut will help that because it'll increase that spread. But again, that's quite marginal compared to the bank's performance over the last 12 months.
Rodda, got to let you get back to what you call it, your ivory tower.
That's the one.
I'll stay in mind. Thanks you, and I'll talk to you soon.
Thank you.